Welcome to Finsherpa. Over the past few years, we at Finsherpa have been putting out an initiative on financial literacy. We have covered over 100 videos out there for you to understand more about investments and financial markets. I hope we are catering to whatever you need. Do write to us if you need to know more about what we want to say. Today, we're going to cover all about bonds. Bonds are great investment products, but they are lesser known about, and that's what we're going to cover today's episode. Now, what are bonds? Bonds are a class of debt investments. Debt investments are investments that are like a bank fixed deposits. They have a fixed maturity time when the money comes back to the investor. Plus, they also carry a certain coupon or an interest rate that stays standard. These are the two features. Unlike an equity product, bonds aren't changing very often, so they are very stable in that sense. So they're a class of debt investments. But what is that about bonds that are interesting is that unlike a bank fixed deposit or any of them, bonds can be for a slightly longer duration. For people who are looking at staying invested for a slightly longer duration, bonds make very, very good choice. What are the different types of bonds? First up, government bonds. Government is one of the largest borrowers in our country, as in many countries. So they borrow through the RBI, and RBI issues the Government of India bonds on a regular basis to fund government projects and expenses. These government bonds are absolutely safe because government is the guarantor in all these bonds. Therefore, these are one of the safest investments that one can do. These bond yields are essentially gilt-edged as they are called, and they are for periods from anywhere between 10 years going up to 30 years in duration. These are also actively traded in the secondary market. So one can not only buy it in the primary, but also sell it in the secondary market if they need. Another instrument that is given by the government is the sovereign gold bonds. Now, we have already covered the sovereign gold bonds in detail in one of our earlier episodes. You can see the link here. So do check out that if you want to know more details. The sovereign gold bonds actually collect money that you would have otherwise invested in gold, so that at the end of the tenure, you get returns that are in line with the returns you would have got by staying invested in gold. These are the two investments that are government guaranteed in that sense coming to you. Apart from these two, you have a variety of different people who offer bonds. Next up, the largest offerers are the corporates. Private companies and public limited companies which have a need for working capital, large companies come out with these offerings on a regular basis. These are corporate bonds. The yields are slightly higher based on the credit risk of these companies, and therefore these are excellent products for investors who want to earn a much higher interest than they get in the bank. Apart from corporate bonds, you also have the PSU bonds. The public sector undertakings are also there in the bond market to raise. The difference is they are not directly government, they are a separate company in which government is majority invested. As a result, you get the best of both worlds. You get the safety to a certain extent, but you also get a higher interest than you would get on a government bond. So to that extent, these PSU bonds are an excellent mix of safety as well as a certain amount of higher return than what you would otherwise get in a government bond. You also have a variety of other bonds which are tax saving bonds. Typically, government also allows sometimes some of these infrastructure companies to come out with bonds where the interest is tax-free in the hands of the investors. These are called tax-free bonds. You also have companies sometimes that come out with infrastructure bonds. The money is collected on these infrastructure bonds, which are mostly by public sector undertakings, is only applied for infrastructure development. Now, these infrastructure bonds, typically in the past we have seen the Rural Electrification Corporation or the National Highway Authority of India, all of them come with these kind of bonds. These also provide a certain tax saving under Section 80C. It has happened in the past. As and when they come in the future, they will be notified accordingly. You also have another class of bonds which are called capital gain bonds. These are eligible to save money if you have a capital gain. Assuming you sold a property and you had a large capital gain, then the capital gain bonds will be the one which you will need to seek out. The maximum cap that you can invest into is 50 lakhs per financial year. You will get the maturity at the end of 5 years, and the amount that you've invested in, to the extent of your capital gain, will not be taxed in your hands, and you will earn a nominal interest of about 5%. Having said that, the combination of the tax saved by investing in this instrument plus the interest makes it sometimes a very interesting opportunity for investors. We have a spreadsheet below that explains this whole concept of why the REC bond, or the capital gain bond as it is called now, is an interesting proposition for somebody to look out for. So these are all the people who offer bonds for investors on a regular basis. What are the different variations of these bonds? Now, all these bonds have different variations. So there is one which is called the regular bond. What is a regular bond? You invest for a tenure of say 10 years, and the interest is payable to you either on a monthly basis, quarterly basis, or an annual basis, as the case may be. Now, all these bonds then pay out according to what the terms are. You also have another bond which does not pay any interest at all. And that's interesting because that's called the deep discount bond. The bond is issued with the idea that it will never pay interest to you at any point in time. Now you may ask, why would somebody invest at all if they're not going to give you interest? So for every 100 rupee face value of this bond, essentially, let's say we had a 5-year tenure deep discount bond, 100 rupee face value. These bonds are issued at a price of 65 rupees, assuming that the interest rate is 7% every year. What it therefore means is, it is deep discounted upfront, you pay 65 rupees, and at the end of 5 years, your realization will be 100 rupees. So to that extent, of course, you're earning interest, but they are called deep discount bonds. There is also a floating interest and a fixed interest bond. Now, the fixed interest bond is where the interest coupon is fixed for the entire tenure. Let's say you invested for a 10-year period. If the coupon starts at 9%, every year you would be paid 9%. But in the floating interest bond, the interest rate is pegged at the government's rate of interest, plus or minus few percentage points. So therefore, as and when the government rate keeps changing, the floating rate every 6 months resets its interest rate. So in the floating rate, your interest rate earnings will also be of a floating nature. It will be up and down according to how the government rate is. First up, for people who want a regular income, like senior citizens or some of the institutions like PF and many of the bodies like municipalities, all of them need bonds that they need to invest on, and where the return is on a regular basis. This fulfills brilliantly for that. From a safety perspective, if you're investing in a government bond, it is as safe as currency. So to that extent, you have safety. For corporate and other kinds of bonds, you need to evaluate the safety before you invest in. Third, in terms of taxation, many of the bonds come in as a tax-free bond. When you invest in a tax-free bond, the return is completely free of tax to you. Sometimes when you invest in these infrastructure bonds, the investment itself is eligible for deductions under Section 80C of Income Tax Act. So you also get a tax benefit there. And most other cases, of course, you will get interest into your bank, which may be subjected to tax. So they are attractive from that perspective. Fourth, bonds offer a certain amount of diversification. You can't put all your money in one basket. Maybe equity is all that you have, or real estate is all that you have. Bonds could be one more place where you get diversification for your investment. So from that perspective, bonds are another good asset class. Liquidity. Now, bonds are also reasonably liquid because most bonds are also traded in the market. So let's assume you bought a 10-year bond, and at the end of say 1.5 years, you have a need for that money. No need to worry. You can go to the secondary market, and trade that bond and collect the money back. So to that extent, there is a certain amount of liquidity available. But of course, you need to ensure before you invest that the bonds are going to be traded. So ensure the liquidity in that bond before you invest. So these are all the reasons why we believe bonds are an interesting bet for people, especially those who are looking at a fixed rate of return and who are looking at a reasonable convenience and comfort, especially for senior citizens. What are the negatives, if at all there are? First up, apart from the government, the corporate bonds or the private sector bank bonds suffer from liquidity problems just in case there is something happening against them. In the last 4-5 years, we have seen a number of bank-related bonds going through difficulty. Not that the private sector hasn't, but bonds have suffered in that sense. You had an ILNFS, which was a large institution that went down. Bondholders tended to lose money. The Yes Bank bond had a problem. So did Lakshmi Vilas Bank bond had a problem. So people who invested in these bonds lost everything. So to that extent, yes, bonds have a risk attached to them. You need to be aware of them. Unlike a debt mutual fund where you have investments across a variety of bonds, which means that even if one company goes down, your money is largely secure. In the case of a bond, you have a singular exposure on one institution. So anything happening to that institution will hurt your entire investment. So let's say you invested 10 lakhs in ILNFS, and if something happened to ILNFS, your entire 10 lakhs is a write-off to that extent. So there are obvious disadvantages when something of that nature happens. It does not happen every day, but it does happen. So one needs to be aware of the risk even before you step in to invest. What are the steps of how you should look at buying or selling these bonds? Typically, one must have a demat account. You cannot buy or sell these bonds without a demat account that you already have. Second, there are these bond traders that are appointed or that have licensed by RBI. So you need to open an account with these licensed bond traders, and they will do a KYC process to ensure that all of your investments can be onboarded by them. Third, after you have agreed to buy a certain bond at a certain price, you will have to enter into an agreement with them, which is evidenced through a document which is called a deal sheet. The deal sheet will contain all the details of the amount of bonds you have agreed to buy, the price at which you have agreed to price, the interest the bond has accumulated till the date on which you are buying, including the details of your demat account and bank account and so on and so forth. Based on this deal sheet which you have signed, you must transfer the money to the trader, and therefrom he will transfer the bonds to your demat account. This is a simple process. Most of it today is done online. Your transfer of money is online. His transfer of security is done online. So a lot of it is seamless to that extent. This is largely the process one needs to follow. Most of the bonds that are traded in India are coupon size of anywhere starting from 1 lakh, 10 lakh to 1 crore in sizes. So if you're looking at an investment in a bond, then you need to look at it in these denominations, not any else. So largely our recommendation is, as an investment vehicle, bonds are a good source, especially for people who want a steady state of return, uncomplicated products, so to say. Bonds will fill that gap beautifully, but you need to take your precautions. You need to do your due diligence to ensure that the bonds are of a high credit rating. Therefore, you don't suffer shocks later.